So I see we have Amanda and Matt with us. They made it. Hey guys.
How we doing?
Great to see you.
Hi, everybody.
And so if you guys don't know who Amanda and Matt are, they are with Keystone CPA. They are my CPAs. They're the best in the biz. And I'm going to read their little bio. As tax strategists and real estate investors, Amanda and Matt combine their passion for real estate investing with their expertise and knowledge in tax strategies. Their goal is to help investors with strategies designed to supercharge their wealth building using entity structuring, self-directed investing, and income offset opportunities to keep more of what you make. Amanda has a highly rated book, Tax Strategies for the Savvy Real Estate Investor, on Amazon. They've been featured in prominent publications, including Money Magazine, Talks at Google, CNBC Smart Money Talk Radio, as well as the Bigger Pockets podcast. Amanda and Matt have a passion for animals and have founded Animals for Armed Forces, a nonprofit organization that has helped to place over 1,500 shelter pets with forever homes. And they are going to share up-to-the-minute information on taxes with us today. We owe them a huge thank you because it is mid-March and they took time out of tax season to talk to us about taxes and the future. So thank you so much for joining us. And if you can share your screen, we will give it to you.
Sounds good.
Thank you so much for inviting us, Anthony. And thank you, everyone, for joining us on this beautiful Saturday morning. Like Anthony said, it's in the middle of tax season. So for those of you who own entities, the deadline is Monday. If you haven't talked to your CPA, do make sure you contact them right away before the deadline.
You gotta, not only is it taxes, but you gotta love Zoom meetings, because I just got back 30 minutes ago from baseball practice. So
Nice.
All right, so we have a very limited amount of time. So let's go over our agenda real quick, and then we have set aside some time after the presentation to go over any questions you guys might have. So I think Anthony will be monitoring those questions, and we can take them at the end if that works for everyone.
Yes.
yeah, so what we're gonna touch on real quick is just some of the latest in tax changes that investors need to know about. The American Rescue Plan just got signed, I don't know, yesterday, 2 days ago, whatever it was. So we're going to touch on a couple things there. And then from a high level perspective, we also want to get into just tax saving strategies for real estate investors, things that you guys should know about. And then we're going to look at, what's coming down the pipeline potentially, right?
Yeah. So let's start. American Rescue Plan was just signed. So this is hot off the press. So a lot of you probably already know, but we have the numbers up here. Sometimes people call this Stimulus 3. So it's basically $1,400 per person for those under 75,000 single or 150 married. And then the phase out is at 80 for single and 160 married. So what this just means that, as a married couple, if you make over $160,000, then you would not be expecting a check from the government. And the same thing for single people who make over 80,000. Okay. Anyone below those thresholds, you'll get full or partial stimulus, and it's supposed to be coming, I guess, any day, any second now, maybe going into bank accounts as we speak.
Yeah, and then one of the changes is that all dependents are eligible now. So this could be in, older child that, 25-year-old that lives at home. It could be an elderly parent. As long as you're claiming them as a dependent on your return, they will count to get the stimulus check. And it is based on the most recently filed tax returns. So there's been a little confusion, a lot of questions about that. So essentially, if you filed 2019 and you haven't filed 2020, they would base it on 2019. Now the question would be is if your 2019 income is a lot lower than 2020, then maybe the idea of maybe to wait to file your 2020 until after you get your stimulus check so you can get the most right now.
Yeah, so just right when it was signed, we ran through all of our tax return clients. I know we have some clients on this call today. And if they were in the process of being filed, and we looked at which year had the lowest income, if 19 was lower, we've told them to hold off on signing the returns until the check comes in. So if your 2019 income is lower, wait until you get that check.
I mean, obviously, assuming there's no other pressing reason why you should be filing your return sooner
yeah,
than
like
later.
getting loans or something like that, right? But otherwise, if your 2020 tax return or income is lower than 2019, which is obviously for a lot of people as well as investors, then it could make sense to file 2020 sooner rather than later. Now, a question we're getting a lot is, do I have to file right away? Do I have to file by April 15th? So they've came out and said that if you file by July 15th, then they will still send you a check for the stimulus payment after you submit the return, even though, right now they're sending it. So there's still that grace period. So it's not absolutely necessary that you submit or file your tax return before April 15th to get this. And of course, worst case scenario, because we do work with mostly investors, and a lot of times people just need time to do the return because they're waiting for K1s, they're still getting their financials updated or getting entity returns done. If you file after that, it's supposed to be a true up credit ultimately when you file your taxes, even as late as next year.
Okay, the other thing to keep in mind that came out for individuals to know about with respect to the rescue plan was that they changed the law. Usually unemployment compensation is taxable to from the IRS perspective, but they've changed it recently so that the first $10,200 of unemployment compensation can be tax-free to you if your income is under $150,000. Couple of things to note there. It's $10,200 per spouse. So it can be $20,400 if you're filing a joint return. But the $150,000 income number is whether you are filing a single return or whether you're filing a joint return. The number doesn't change because you're single or married. Okay. So that was interesting for us to know, because usually there's a, doubling of the number if you're married or something.
Yeah.
But
and this was just signed the other day, but it is retroactive to 2020. So clearly, some of you might have already filed your 2020 tax returns. That was reported as taxable. So we're not really sure how this will be trued up. IRS has said to just hold off and wait. It's possible that they will run this through their system and give you a tax refund automatically, or they might require us to file amended tax returns. But as of today, there's not a clear indication what to do, but
if I was a betting person, I'd say you'd probably get your refund faster if you filed an amended return versus waiting on the IRS.
To contact you, right? Yeah.
All right, a couple other things to note. Economic injury disaster loans, otherwise known as EIDL. Right now, the way the law is that the loan proceeds you receive are not taxable because it's a loan. Remember, the EIDL had the part that was they had the grant part too, right? Where they give you $1,000 per employee. The grants are not taxable to the IRS, but currently they are taxable to the state of California. So for anybody on the call, a lot of you may be in California. California is going to tax you on that $1,000 per employee. Now that might change because there is an assembly bill going through and they're doing a lot of discussions about changing that, which is awesome because tax season's already in effect, right? So that's what we love as CPAs when they change the law halfway through tax season.
Yeah. So if you're a landlord or flipper, you're an investor who received EIDL grant and you're in California, the recommendation is for you to go on extension. I know we just said that the deadline is Monday, but the reason to go on extension is because if you don't, under current law, those amounts are taxable to you. So might as well wait until this assembly bill goes through the system and see if it actually gets passed. And similarly for PPP loans, right? We talked a lot about this a year ago this time. So same as any other loan, PPP loan proceeds are tax-free money to all of us as investors and business owners. IRS has said that when you use PPP money to pay for business expenses or rental expenses, you can still write them off, right? Even though it's the government gave you the money, you still get to take those deductions. So it's tax-free and you get a write-off. Again, California does not follow federal purposes. So California says you can't take deductions for those expenses if you had a forgivable PPP loan. What does that mean? It just means higher taxable income for California purposes. Again, the good news is there's an assembly bill that's going through California to potentially make this deduction allowed. So if you had a PPP loan as well, and you're in California, it is recommended by us, at least, check with your CPA. We do recommend you go on extension to see how this all falls out.
Sure, I'll keep in mind, it could be, look at your numbers, right, too. It's if your PPP loan was $5,000, maybe that's not a big swing to you for California purposes, and maybe you're waiting on a California refund. Those are the kind of things to talk to your CPA about. The other thing to keep in mind with the PPP loans is there's another round of funding that's available right now. The application date is March 31st. The recent change with it is that they made it available to sole proprietors to use gross income in your calculation of how much loan you need instead of your net profit. So a year ago, sole proprietors could apply for the PPP loan, but they had to base it on net profit. Now, obviously, using gross income can, open up the door to a lot more people. So that's a good change.
Yeah, so this applies to individuals, right? Sole proprietors, also single member LLC. So if you're single member LLC filing on the Schedule C return, this is something that you potentially could look into. So this would be for active income in the real estate sense, realtor commissions, property management fee, fix and flippers, wholesalers, right? These types of income, not for rental income.
Okay, the next thing up here is just kind of a fun little slide we throw up sometimes to kind of keep you guys awake, make sure everyone's paying attention, right? This is just a summary of some of the, more interesting tax court cases of what people have been allowed to deduct. Interestingly enough, there's, I think, 2 or 3 on here that are related to real estate investors. I think the private plane was one, right?
Yeah, the private plane was where there's an investor who bought a plane and tried to write it off, take depreciation and all that. And they decided that IRS decided that was not a reasonable expense. But when the investor took the IRS to tax court, they actually won and said that was reasonable, that this person or this investor needed a plane to operate their real estate activities. One of the reasons we like to show this slide is because, we all know tax changes have occurred last year. Tax changes are coming up, which we'll be talking about shortly. But one of the things that is still stands true is that there's always deductions that you can utilize to offset your taxable income. And a lot of times as investors, we're only focused on, interest, property taxes, management fees, when in reality, there are a lot of other expenses that are legitimately tax deductible. And if you're someone, between federal and California in the 30 to 50% tax bracket, $100 worth of write-off can save you $45 to $50 of cash, right? So it does add up over time. Not to say that we can all write off our airplanes and breast augmentation or, swimming pool, but these are examples of things that the courts have allowed.
Sorry, Anthony, no breast implants, buddy.
Oh.
But these are things that have been allowed in the past. And so the key, as we're heading into tax season, a lot of you are probably meeting with your CPA soon, is to talk to them about where you're spending your money. If you're spending money on some significant items, ask the question of, how can I write this off as a tax deduction, right? So then you're in a more creative mind to think about whether something is deductible or not, okay? And we'll go over another example. One of the things as investors, to minimize our taxes is to look at income shifting. And income shifting is really just it's just like a more savvy way to call, how do we take a tax deduction for money that we're giving to our kids?
That's us accountants trying to come up with a creative name for something, right?
Yeah. So usually if you say, hey, I'm giving money to my kids, I'm spending money for my kids' allowance, can I write them off? And the answer is no, right? Because those are personal expenses. So the question again is, how can I write off the money I'm giving to my kids? And one of the ways is through income shifting. And by that, what we mean is not necessarily just giving your kids money, but somehow having them help out in your real estate business so that you are paying them for the work that they're doing for you. Again, as an example, if you paid your kid $5,000 and you're in the 40-50% tax bracket, that could be a $2,500 tax savings per year that you're receiving, right? Federal and California purposes. So that's pretty significant. The only difference is instead of just giving them money, they're now working for you, helping out in your rentals and your flips. You can pay your kids just like you can pay anyone, right? You can pay Anthony to help with your flip, and you'll take a tax deduction. So same thing for kids. Of course, it does have to be reasonable. It does have to be legitimate. It's not just, hey, I'm saying I'm paying them, I'm saying they're working. You do actually want to substantiate all of that. And we're happy to take questions later on when we open this up, because I know we usually get a lot of questions on the income shifting side.
Yeah, so this picture might make it look like this dad's teaching this kid how to help him with real estate, but it's probably the kid teaching dad how to use Zoom, right? So another good strategy, one of our favorite strategies with respect to real estate investors, is looking at maximizing depreciation. And there's various ways that we can do that. We can do that through, maximizing a repair deduction. We can look at doing bonus depreciation on new appliances and things of that nature. But we know big picture, powerful one is looking at cost segregation study and then teaming that with bonus depreciation. Because a couple of years ago, they brought back 100% bonus depreciation for 5 and 7 and 15-year assets. And so on a cost segregation study, for those of you who don't know, all you're doing when favorite things about rental real estate is depreciation, right? So when we buy it, we depreciate a residential house over 27 and a half years, or apartment over 27 and a half years, or commercial property over 39. But when we do cost segregation, we're looking at ways to take more depreciation sooner, right? Bring more deductions to play so that we can reduce our taxes now, reinvest that money into more assets. And so you do that with a cost segregation. And the power behind it is people, you hire a company to come in, and look at the entire property. What they're doing is they're breaking down components of it from the 27 and a half year building into the 5 and the 7 and the 15-year assets. That by itself is great. But then when you team it with 100% bonus depreciation that you can get, now all of a sudden, when you're allocating things to the 5, 7, and 15-year assets, you're taking a 100% write-off of that in the first year. So we can look at some numbers here.
Yeah, I think it's just coupling that with the current, at least in 2020 as well as 2021, right? For those of you who haven't filed last year's return yet, this is still a potential opportunity. So if we say we have a rental that we buy for $300,000, right? And we put 20% down payment, so $60,000 down. And let's say, for example, that the building value of this property is $250,000. Okay, probably not a California property unless it's inland somewhere, not a beachfront for sure. But let's say in our wonderful example, the building is $250,000 with bonus depreciation and cost segregation. Again, both are available right now. The first year depreciation alone could be about $75,000 in taxes. Okay, and assuming someone is 37% tax bracket, first year tax savings is about $28,000 in cash. So a $60,000 down payment will get you a $75,000 write-off, right? Pretty amazing. So your first year write-off is more than the down payment that you put on a specific.
You essentially get, in this example, you essentially get half your down payment back, right?
Yeah. And this is a huge one because, as investors, we all love leverage. And this is a great example of how leverage works out in your favor, where we're getting a huge write-off on using the bank's money today, right? And it's interesting because I'm scrolling, I see a lot of faces on here that are clients, and a lot of you are using this strategy as we speak. So this is something that's still available, supposed to still be available through 2021. So, huge opportunity for investors that we hope to keep in the coming years.
Now let's shift gears, and we'll take questions on that later too. So now let's shift gears to talk about some potential tax changes that might be coming down the pipeline. A lot of it we don't know, to be totally honest with you. Don't shoot the messenger here. We're just, we're all waiting anxiously, just like a lot of people. But here's kind of what we do know. When the Biden administration was running through the leading up to the election, one of the things that they talked about was I think his quote that he came out was saying, we want to roll back unproductive and unequal tax breaks for real estate investors with income over $400,000. Now, obviously that's a mouthful, right? I mean, who wrote that? They paid somebody in his staff to write that, right? But
yeah, it's difficult to know what the meaning of unproductive or unequal tax breaks are, right? But there's a couple of things we know for sure. One is we know taxes are likely to increase. Why? Because tax revenues have gone down because of the previous Tax Jobs and Cuts Act. So revenue has gone down, spending has gone up clearly, right? Now, as we're celebrating the American Rescue Plan, it just means more deficit in reality. So someone has to pay for it. So we know taxes will go up. And we also know that there is somewhat of a target on real estate investors, right? This is something that's part of the policy proposal. This is like the big bad real estate investors, okay? So this is what we know. Tax increases, some of those at least will be targeted for real estate investors. But what are the things we don't know? And like Matt said, there's a lot we don't know. So we'll go to the next slide. What we don't know is what are the actual changes, right? All we know is unequal, unproductive. That could mean all sorts of things. We don't really know what exactly the changes will be. And also, we don't really know when those changes will take into effect. Are we talking right away? Are we talking later on? And so in times of unknown, what we typically like to do is take a look historically and say, okay, what happened in the past? Maybe that'll give us indication of what's going to happen in the future. And so historically speaking, usually major tax bills will pass in the first year of a newly elected president. So this happened with President Obama, with President Trump, and then now potentially with President
I think even
Biden.
with President Bush too, going back 20 years ago, I think, if I remember correctly.
So that's historically speaking, but 2021 could be very, very different, right? We're living in very different times right now.
Yeah, I mean, obviously there's a lot of issues out there. I mean, not COVID alone. I mean, there's unemployment, the economy. They are talking about tax changes. So it's a question of what are they going to put first, right? What are they going to bring to the table, put their most energy towards? I don't think it's going to be taxes necessarily right away, but obviously I'm not in Congress. I mean, and the other thing, they kind of do have a divided Congress, right? I mean, it's almost essentially split down the middle. And so is it going to be significant changes versus smaller scale stuff? And that's, where do you fall in what you're thinking they're going to do,
Yeah,
right?
I do think the expectation at this point is that it's going to be more smaller scale changes rather than all of the items that were initially on the wish list. Or I guess that would be our do not wish list, but that's on the increases side. So timing of tax changes, a couple of possibilities, right? So if they change something, it could be retroactive to January 2021. Or it could be go forward. So if law changes.
Some might be asking, how can they make it retroactive to January 2021? But we just talked about how they're making tax changes retroactive to the beginning of 2020 right now, right? So
Yeah,
don't be surprised by that,
Yep, the unemployment, maybe PPP changes, those might all be retroactive to last year. So it could be anything. Now, so I will say for tax increases, though, we don't expect that to be retroactive to last year. We just think it'll be tax decreases or benefits, might go backwards in time. But also there's a possibility of phased in over multiple years. So they could sign something into law now and then say, okay, part of this will take into effect in 2022 or over the next 5 years, like more of a phase in. And that's honestly what we're hoping for. If there's going to be increases, we want that to be go forward, phased in. Why? So that could give us more time to plan, right? To plan ahead and say, okay, what are we going to do? What are things that we're going to be losing?
Now let's just jump into kind of some of the things, the more specific things that they mentioned. Now, again, these haven't passed yet, but just going back and looking at as the lead up to the election and all the policy proposals, these are more specific things they did talk about. So I would say, probably from a focus standpoint, this is what, more likely to happen if they're going to pass something. They're looking at increasing the top tax bracket back up to 39.6%. So right now it's at 37%. So, on the face of it, that doesn't sound like a lot. But keep in mind that 37% bracket starts for a married couple a little over 600. They want to bring that threshold down to $400,000.
So more people
will kick into the highest bracket sooner. The other thing they're looking at doing is changing how capital gains taxes or how capital gains income is taxed for those making over $1 million of income. Again, why they're choosing 400,000 in one area, $1 million here, who knows, obviously, but essentially, they're going to basically want to tax capital gains income for those high income earners as ordinary income, essentially, right, at the highest tax bracket. So that'll be interesting to kind of see how that plays out.
I think sometimes, as investors, we always talk about the tax benefits, almost feel like we're immune to the tax increases. But one thing I think a lot of people don't talk about is a lot of real estate income is taxed at ordinary rates currently, right? So rental income, if after you use depreciation, all the write-offs, you have taxable income, it is taxed at your ordinary rate. It's not some kind of a lower rate. And so for a lot of investors who own real estate for many, many years, maybe fully depreciated, these are things that are potentially troublesome coming up if these were to be passed. Now let's talk about some of the unknown changes that's been thrown out there with respect to potential changes. 1031 exchange. I think a lot of you might have heard about this. 1031 exchange currently basically allows us to sell a rental property and buy a replacement property and be able to defer the capital gains taxes. There are talks of that potentially being modified or maybe going away and potentially only modified for people making over $400,000. So there's not a whole lot of clarity on that. But the good news is, though, contrary to what you're hearing, this 1031 exchange potential change was not something actually in the tax policy proposal. This is not a proposal. This was just someone
on his team, I think.
Yeah,
right?
Someone in the campaign had indicated, yes, this possibly could be a change. But what are some other possible changes? Well, depreciation, right? Real estate professional status. If you go back to that initial thing we said, which was the exact quote of rolling back unproductive, unequal breaks for investors. Well, all those things that we talk about are quote unquote unequal, right? Because if they don't invest in real estate or they're not a business owner, then they don't get bonus depreciation. They don't get to write off rental.
Obviously, you as an investor, it's productive for you to use it, right? But unproductive to them raising revenue, I suppose.
Yeah. So there's a lot of speculation on kind of what those changes are going to be, but As of today, we don't, we're not really seeing anything definitive about 1031 exchange. Earlier, we talked about the timing of things, right? When you do a tax change, it could be retroactive or going forward. So one thing for 1031 exchange is, if we had to guess, right? If they do change 1031 exchange, it would be on a go forward basis. Meaning, if you're in the middle of a 1031 exchange now, or if you're going to do one before they pass the law, I find it very hard to imagine that they will disallow those transactions.
Right. So like a law is passed October 11th. And if you did a 1031 exchange on October 10th, you'd be okay. But if you did it on October 11th or 12th, you wouldn't be, that kind of thing.
Yeah. So if you're someone that's looking to, switch positions on some of your real estate, getting out of California into those other properties or switching out of these to other properties, now is a good time to at least start thinking about those things. Again, because if they were to sign the law, it could be effective on the date of signature, and you might be scrambling to try to put something together at that time, right? Not necessarily mean you have to sell right now, but at least be thinking about that and look at your portfolio. What are some of the ones that you want to hold on to for the long term if there's a significant change on the 1031?
Yeah, because in terms of strategies to consider, a lot of the strategies that have been working are going to keep working, right? We talked about income shifting, cost segregation, but right now those work, and you want to be able to take advantage of the things that are still out there. So, big picture, they threw out that $400,000 number a lot, right? So clearly, one of the strategies would be keep your income below $400,000 in whatever way you can.
I think it's not difficult for a lot of investors, right? Because we have so many write-offs and things like that. But nonetheless, maximizing write-offs, shifting income to kids, shifting income to a C corporation, maximizing retirement contributions,
right.
Just all the usual stuff that we're talking about, those still work great. The timing of your transactions, again, something to consider right now because we don't know what's going away. So just be prepared, look at your portfolio, see what maybe you want to sell, and kind of have a plan for that to implement in case the law does change.
Yeah, some other things too. Look at offset strategies. I mean, real estate professional is a great one. Cost segregation, maximize appreciation. Also, there's a lot of charitable gifting strategies you can implement to offset your income and bring it down. And so there's things that you can take advantage of. And just because they're going to change the tax law or they might change the tax law doesn't necessarily mean that things aren't going to be, or strategies aren't going to be available for you. So
yeah, I think, as investors, your main job is really to keep your line of communication open with your tax advisor on any upcoming transactions that you have. Because without, the more that they know what you have going on, what you have planned, the easier it is for them to help you versus if you're calling them after you sell a property, there's, not as much that you can do to save on taxes. But also on your end, making sure you have a plan in place for yourself on how you're going to be able to maximize your tax savings. Like we said before, all the usual write-offs and strategies still work. And so if your expectation is that taxes will increase, and I think that's a lot of us here tonight, right? If your expectation is that's going to increase, now is even more important than ever to make sure that you have a plan in place to protect yourself. So I know Anthony asked that we put together some resources for like download stuff. Unfortunately, because we're in the middle of tax season, I didn't have time to put something together. But we do have a Jumpstart tax savings course that's for sale on our website. And so I threw together a coupon for you guys. If any of you guys are interested, you can use this coupon on our website. It's keystonecpa.com/jumpstart. And it's just a mini course we put together. It'll show you, we go over like the top 10 strategies for real estate investors in terms of tax savings and 6 steps to having an effective tax savings plan. And then you also get to download a tax risk barometer, which basically is a self-assessment to see, because people are always asking us like, am I overpaying in taxes? How do I know? So we put together something that kind of helps you to self-assess by answering some of these questions and just, for yours to keep. So the code for any of you who can't see the screen is MFS2021, MFS2021. You can check it out on our website and download that if you want. So should we go to the Q&A, Anthony?
Yes, thank you so much. So we've also put these slides in the download section on that companion page. So if you missed this or writing it down, then you can always take that there. Thank you so much, Amanda and Matt, for sharing that with us. I think there's probably way more information in that course than there would be in a little download. So it's very generous of you. We got a lot of questions on cost segregation throughout the talk. So
Okay.
we'll talk about that here for a minute, I think. And then if other people have other questions, enter them in. We do have a little bit of time here. So I know the most, there's some questions on like sale, and I think we need to talk about depreciation recapture and bonus depreciation, how that's wrapped in. But I think first and foremost, there's that line, right, between active and passive income that I think is important for people to understand how that works. And there's probably a lot of people that are real estate investors that may not be real estate professionals. Can you touch a little bit on, when does it make sense to consider doing a cost segregation study? And is that a benefit to somebody that can't offset active income? And then maybe on top of that, what is that real estate professional status? How do we get it? And, what does that do for us?
Okay, well, that will take about 30 minutes.
There we go.
All right. Hey, we do talk about real estate professional status in our Jumpstart course. So download that. We do have a lot of details on that. But just real briefly, if you're someone who makes under $100,000 total income and you invest in real estate, you can use up to $25,000 of rental losses to offset your other income.
Okay. And obviously the goal when you're investing in real estate is not to generate losses, but so when we're talking about paper losses, right? You're like, utilizing income shifting and, home office deduction and maximizing depreciation. So things you're already spending money on, right? Taking tax deductions for them.
Yeah. So now for people who make over 150,000, so if you're making between 100 and 150, you get to use some of those losses to offset your other income. If you make over 150,000, then you cannot use your rental losses to offset taxes from W-2 income anymore. And that's the downside, because basically they're saying, hey, this is kind of real estate is your side thing that you're doing, so you can't really use that to offset W-2 taxes. And this is where the loophole of real estate professional comes in. So if you or your spouse are a real estate professional, you can use rental losses to offset all types of income without any limitations. And so that's really, for someone who is of higher income, real estate professional is an important strategy because it does allow you to kind of merge the two worlds and have cost segregation and all the strategies to not just wipe out taxes from rental income, but also W-2. And so, in short, to be a real estate professional does not mean you're a realtor or a broker or anything. It means that you're spending at least 750 hours in your real estate, and you spend more time in your real estate than your other jobs. So if you're someone working full-time, 2,000 hours at your job, you have to spend more than 2,000 hours a year to be a real estate professional. So you can see how that's kind of a harder hurdle to overcome. But we have clients who maybe are married, one person's a stay-at-home, where one of the spouse can be able to meet that 750 requirement and use rental losses to offset all sorts of income.
Now, in terms of cost segregation, so when does it make sense? Clearly, if someone's going to be able to qualify as a real estate professional and you can do a cost seg to generate a bunch of extra depreciation, use that to write off against W-2, other income, that makes sense, generally speaking. But it depends on what tax bracket you're in too, obviously. So you want to make sure you're in a bracket that you don't want to necessarily be using a cost seg to save at 10 cents on the dollar. So, can you qualify as a real estate professional? What tax bracket are you in? If you don't qualify as a real estate professional, cost segregation might still make sense if you happen to have a lot of positive income from your rental properties or other passive investments. So maybe you've invested in somebody else's business. You're getting a K1 that's just spitting off $100,000 of profit. That's still passive income to you. So you could use losses from your rental properties to offset that passive income. So that would be a case. Another one is short-term rentals. That's really popular in the marketplace right now. A lot of our clients are getting into short-term rental space. There's ways that if you can materially participate, which means you're really, really actively involved in your short-term rentals, and you can generate losses from those short-term rentals, you can use those to offset your other income without being a real estate professional. So if you find yourself in that situation, then a cost segregation study on your short-term rental or rentals might make sense in your situation as well.
Interesting. And so then you mentioned this briefly at the beginning, and I went back and looked at some cost segregation studies I had done on my properties, but this bonus depreciation right now is insane. Like,
yeah, it really is. It moves the needle so much when people do cost segregation studies.
So just a general guideline, because I know a lot of people want to know this question, is what's a benefit of a cost seg, right? So typically we're looking at between 15 to 30% of the purchase price of the building. So if your building was purchased for $100,000, first year write-off is anywhere between 15 and 30,000. Right? It's a good kind of a high level way to gauge how, how beneficial it is. Because in the past, people are often under the misconception that cost segregation is only for the big guys, apartment owners, commercial real estate, but that's not necessarily true, right? Especially in California, you can have one single family home that you're paying $500,000 for. That's not uncommon. And because depreciation is based on purchase price, this is why we're seeing a lot of single family homes even make sense to do cost segregation in terms of wiping out, or not wiping out, but offsetting taxes significantly.
Yeah, because they a couple of years ago, I think alluded to it earlier, they brought back 100% bonus depreciation. Like before it was like 50%. But the other big change they made a couple of years ago was that allowing it to apply to used assets. So before it had to be a brand new refrigerator you bought, but now obviously you buy a property that's been around for 20 years and you do a cost segregation. All the 5-year assets, the personal property they're breaking out, none of that stuff is new. But now because they changed the law to apply to used assets, now that can apply to bonus depreciation. So bonus depreciation is set to be here for right now for 2021 and 2022 at 100%. 2023, it's supposed to scale down to 80% and then 60% and go on down like that. Again, that could change depending on what the Biden administration does with taxes. But right now, it's something to definitely take advantage of if your situation's right.
And that applies for 5 and 15-year buckets?
Yeah, 5, 7, and 15-year assets, yeah.
Uh-huh. And then what about like new improvements? Like if you replace a roof or something?
Yeah, so couple things there is so we'll talk about the roof in a second, but you bring up a good point. Those of you who maybe are investing in commercial properties, so non-residential, office building, medical, strip mall, something like that. If you're doing, they changed the law recently too with respect to interior improvements. So before, if you made improvements to your commercial property, generally they're going to be depreciated over 39 years. But now most interior improvements are considered 15-year assets now. And because of that, they are allowed to take 100% bonus depreciation. So for those of you guys with commercial properties, that can be a big change. And then on the roof question, a lot of what they did was make it easier to, a lot of times if you're replacing a roof, you're going to have to capitalize and depreciate the new roof. But what they allow you to do is actually write off the cost of the old roof. So theoretically, you're buying a property, it's got a roof on it, hopefully, right? And there's a cost associated with that. And so even if you have to capitalize a new one, most of the time, there's calculations you can do to write off the remaining, we call it tax basis of the old roof. So you're still getting a deduction in some fashion.
Awesome. Brian Miller's got an interesting question. What if I convert my primary residence into a rental? Can I do cost segregation on it?
Great question.
Yeah. So you can do a cost segregation on any rental property, including a primary home turned into a rental. And like Matt said, now with the new rules for bonus depreciation, that doesn't have to be brand new assets anymore. So it is possible that on this home that you turn to a rental, it might also be eligible for the 100% bonus as well. A couple of caveats, so depending on like when you bought it, when you put it into service, but yeah, certainly something to talk to your tax advisor about.
Interesting. Here's another good one. So we're going to talk about ADUs is actually going to be our next segment with our architect. And Chris asks, in California, if you convert a garage or something to an ADU, does that impact cost segregation? Are you able to do that on new construction to an existing property?
Yeah. So if you convert a garage to like an ADU and it's specifically turned into a rental property, not only, when you bought the property, there's, based on the square footage method, a portion of your cost basis would be attributable to the garage, right? But then if you add, $50,000, whatever, to change it to $100,000 to change it to an ADU, whatever it costs, that you can actually, instead of allocating, based on square footage of the whole house, you can take that entire cost and apply it to the rental property because that's what it is. It's related to the rental property. So in that situation, yeah, you would take your cost of construction, and then if you did a cost seg on that, you could break out the 5 and the 15-year stuff related to that. So that would be a powerful way to offset that.
Oh, that's awesome. That's great to know.
Love
so What about the downside? So it's cost segregation is great. I've definitely taken advantage of it. You guys have helped me with that. Thank you. But so what happens if you cost segregate a properties and just sell it and not exchange?
Yeah. I mean, and that's exactly why you need to work.
Anthony is our plant. We plant him with questions.
Yeah.
And
And that's why you need to work with your CPA on that, right? Because if you do a cost segregation now and just to sell your property 2 months later, it may not make sense because you've accelerated income to 2020 just to pay more tax, just to kind of repay all that savings in the following year in 2021, right? Because basically when you do a cost segregation, you're accelerating the write-off in the future. But then if you sell the property, it decreases your cost basis because you already wrote it off. And so it just means that you have a larger gain. It still could make sense. We have seen that in specific scenarios. Let's say if it's, we'll pick on Anthony. If Anthony had a huge year in 2020 where his tax rate was very high, and we say, yeah, still let's do a cost seg anyway, even though you're selling the property and you're not going to 1031 exchange, because maybe in 2021, your income is going to be very, very low. Taking a leave, you're not going to work as hard. And then we don't really care as much because maybe that capital gain is going to come back at a lower rate compared to what you saved in the year that you did it, right? But otherwise, yeah, normally speaking, if you're someone whose tax rates are pretty similar from year to year, and you tell me you're going to sell something next year, generally the recommendation would be to skip cost segregation. Unless you're going to do a 1031 exchange, right? Which most investors, whether they do a cost seg or not, a lot of investors do 1031 exchanges. So if you do that, there's usually no issues with that because you just continue to defer that tax down the road.
So if you exchange repeatedly until you die, does that gets wiped out with your whole step up in basis as well?
Yeah.
swap till you drop, dude.
Yes.
Yeah, that's what we talk about, where you continue to defer an exchange, and then you pass away and you leave it to your kids, and then they'll get the step up basis. I do want to say a caveat. We took it out of today's presentation because of time, but that is something in the proposal that might change in the coming years where they take away step up basis. So that's, if they do shift that, then a lot of the tax planning surrounding that will shift accordingly too. But as of today, yes, that's still a good strategy.
Awesome. Marty's got an interesting question. Can you repeat interior improvements to apartment buildings? And then I assume what the follow-up question to that is then can you depreciate them again? It's like if you've got a tenant that beats a unit up and then you replace everything.
Yeah, there's actually a couple ways to deal with that. I mean, the best way is if you're doing that when, we tenant turnover, right? So somebody moves out and you got to kind of get it rent ready for the next tenant. You put $5,000 into carpet, paint, fixing some things up. A lot of times you can deduct that right away because it's just normal, maintenance, routine maintenance, right? But let's say it's outside of that and you just want to, fix it up every year or something, when it does allow you to kind of, if it's the stuff that's like a 5-year asset, some of the personal property stuff, you can take bonus depreciation and write it off, do it again a year later, do it again, if you weren't able to write off the first one, when you put in the new stuff, you can do that partial asset disposition like we were talking about for the roof. Same kind of theory is that if you're replacing something and you depreciate the original one, now you can dispose of it, take a write off of the old one, and then, start depreciating the new one. So there's a couple different ways to do that for sure.
Awesome. Okay, last question. Chi, thanks for joining us. She brings up a great question that's very confusing right now for California investors. Didn't they already take away the step up in basis via Prop 19 in California? And I think we're talking about, right, the difference between income taxes and property taxes then.
Right.
Exactly.
Yeah, there was a big change to property taxes with respect to California. There was two things. There was the homeowners moving in the state. And then there was also kind of we call it inherited properties, but it's almost like inherited, meaning most people think of inherited like you're getting the property when somebody passes away. But so say gifted, right? A parent passes a property to you. So non-primary residents. So if you receive a property from your parents, say, as of last month, so in the middle of February, you can't get their carryover basis unless you continue to use their property as your primary residence. Or the other exceptions like a farm or something. I don't know how many people are farming, but that's one of them. So if you receive a property as a gift from from a parent or grandparent, you can get their carryover property tax basis if you continue using it as a primary residence, but there is still things in the law that allow them to increase the taxes every year if the value is over $1 million.
And that's different than what we were just talking about
Yeah.
with 1031 exchange, because 1031 exchange is a way to defer capital gains taxes that we pay personally. So not related to, property taxes at the county level. And then the step-up basis currently is, again, on the federal level, where we say, okay, if we leave something to the kids, we buy something for 100,000 and it's worth $1 million by the time we pass away. That's where the estate tax comes in, or some people call it death tax. And so currently there is a basis step up. So when our kids inherit that property, it's assumed as if they paid $1 million for it. So when they sell, that first $1 million is tax-free money to them. So yeah, I think I think you're right, Anthony. There's huge confusion between that and Prop 19, which is strictly on the California property tax. And we pay all sorts of taxes, guys: federal income tax, state income tax, property tax, sales tax.
Don't get her started.
Use tax. I don't know.
But it's beautiful here, so we pay the premium.
It is. Yeah. I mean, people all over the U.S. pay those taxes, right? A lot of people are saying, hey, move to Texas, but Texas has very high property taxes,
Yeah.
So it's.
Well, and they have hurricanes and tornadoes.
Yeah.
Awesome. Well, thank you so much for giving us 45 minutes of your time on a Saturday in the middle of tax season. We really appreciate it. Your insight is, as always, invaluable. Everyone, if you have further questions, you need some more information from Amanda and Matt, of course, reach out to them. Their slides are in the download section. Definitely sign up for their course on tax savings, and hopefully you get all set for 2021. So thanks again for joining us, guys.